No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrot, your host. We were talking last week about annuities. There was a great piece I shared with you from Nationwide Retirement Institute titled Be Outliving Your Life, Not Outliving Your Savings. This week we're going to, and that kind of lays out a bunch of the basics, and we'll do a little recap there. And then I want to talk to you a little more advanced as far as how annuities can help you. Why this talk of annuities? I've got more and more interest from clients that are nervous about the market, and this is one of the reasons, of course. We see the Dow is down 13% year to date. The S&P 500 down 18% year to date. The Russell 2000, that's our small caps, that's down 23% this year to date. And in NASDAQ, down 28. At one point, I think it was up over 30. So these are the numbers that we're concerned. When you get double-digit drops, I mean, 10% drops from and in that neighborhood, which we're about the Dow is, we see that usually about every year. However, when it comes to some of the other drops, if you will, when we're getting up into 20% range, now we get a bit more nervous. That's a little rare, and it concerns those that are concerned about a bear market, that type of thing happening. Here's the other part. When you have the market do this, okay, when you have this type of adjustments going on, this type of volatility, one of the things that has been a good way to stay ahead of that are bonds. Unfortunately, this year, not so much. We're seeing bonds are down almost 10% as well. So where's the safe haven? Well, one of the things, remember, I've talked about this gentleman a few times on this show. His name is Roger Ibbotson, an economist known for stock, bonds, bills, and inflation chart that's all over our industry. Roger did a research piece, and in his study, he found that fixed index annuities beat out bonds, that they outperformed them. If you'd like to get a copy of this, just call my office, and we can get that for you. I'll give you an opportunity with some other reports as well. One of those that a Morningstar report going to be talking about. But first, going back to Roger, so in his research piece, fixed index annuities beat out bonds. This is one of those times when that can be a big plus, as an example. When bonds are down almost 10%, if you were in a fixed index annuity or you had some of that in your portfolio, then you would, your worst case is a zero, okay? Now, some of them you may have a fee that comes out each year, but as far as market performance or volatility, we're talking the worst year is a zero, and the best year, and this is where different products have different rules. Some of them have caps. They say the most you can earn is 5%. That means you're going to be between 0 and 5, probably averaging 2 to 3. There are better options than that. So we don't want fixed index annuities that have caps. The next would be an uncapped fixed index annuity. Now, if the market or the particular index you're following, if it goes up by 10%, then it's based on your participation rate. So for some, that can be 50%, which we commonly see, and even less on the S&P 500 index, or some of the other indexes that are available out there, like the Shiller Cape, Wisdom Tree, Citibank's Grandmaster. So there's a number of them, and these you're looking more participation rates over 100%, 150, 200 even. Seems crazy, but that means if that index goes up 10%, you're going to get either 15 to 20% on your money. Now, it doesn't, when we're looking at averages, if you look at a typical illustration, they can run anywhere from 4% up to 10%, depending on the period of time. So again, it's important to make sure you get the right product for your given situation. And I've got a few pieces to help you with that. We've got a company called Allianz. They're an A+ carrier. And so in addition to the Ibbotson piece I just mentioned, they have one here, Understanding Fixed Index Annuities. So if I'm going to talk more about them today, but if you'd like a piece from Allianz, just again, call my office. And let's see, we've got a few other pieces. The Wall Street Journal, Why Annuities May Be Safer Than You Think. financial verse, the misunderstood cash power of annuities, role of annuities in comprehensive retirement portfolios, features of a fixed index annuity surrender charges, and then the Insured Retirement Institute, understanding fixed index annuities. So I've got lots for you. There's also a Annuities 101 piece. So lots of material if you'd like to get it. We're going to talk about these things today. So why annuities? Okay, when we're looking to get a rate of return on our money, here's something to keep in mind. I've talked to you also about the safe withdrawal rate of your money. If you're taking up to, say, we used to call it the 4% rule. And this went back to the mid-90s. Gentleman, I think William Bergen was his name, is a financial, I think he was a certified financial planner, but his research showed that in rolling 30-year periods, you could safely, in a 50-50 stock and bond portfolio, properly done, you could get a safe 4% withdrawal without having to worry about running out of money. Morningstar did a recent report, and they said under those same criteria that he used back in the 90s, based on what the market's done since and some other factors, they dropped that down to 3.3%. And by the way, this report from Morningstar I can make available to you as well. So, but then as you dig down into the report, it's not just that they're talking about the safe withdrawal rate. How much money can I take? And when we're talking about a safe withdrawal rate, we're increasing it with inflation. Okay, because if you're just going like, you just got a flat amount, and many pensions are like that, and it doesn't change. Like Social Security goes up with inflation, and your more or less portfolios stay flat, or sorry, pensions, that is, stay flat, or most of them do. Some federal employees will have COLAs in theirs. So what do you do with it when we're talking about taking money out of your account? We're talking about a safe rate that goes up with inflation. So you're starting at 3.3, and then it goes up a little each year for inflation. But one of the things that fixed index annuities can do is they can provide you guaranteed income. They can have you tied still to the market indexes that you're following, and that can give you market return increases, which is going to, historically have stayed ahead of inflation and taxes. And then some of them even have inflation riders or way that your income go up as well. And that's what you want. You want something, if your income stays the same and prices, in particular, we see that right now, prices go up, you're going to need to use up more and more of your money to keep up, and that's where that safe withdrawal rate really comes into play. Another thing fixed index annuities can do is they can help you get a higher, with an income rider, a higher percentage than just the 4. I've seen 6, 7, 8% and even more as a withdrawal rate, and it's safe because it's guaranteed. If you ran out of money, they're going to keep paying you. So it allows you for a greater amount of income. Because this is, I dig down into the Morningstar report, and I've seen this in other things as well when we're doing research and hearing how people are working. They're saying basically low starting bond and high equity bond yields and high equity valuations are unlikely to sustain the higher portfolio withdrawal rates, so they're going to have to reduce them. Now, some of the things they're talking about doing for that is they refer to it as adopting a more flexible spending approach. More flexible spending. In other words, when the market's down, you stop spending money. That's flexible spending. It's you reducing your lifestyle based on what the market's doing. Not the best of plans, and most of us, we have our necessary expenses that we need, for our living expenses, housing expenses, car, all those things. And then we have discretionary or fund money, as I refer to it, for the things that we want to, our leisure activities we want to pursue. So how many of us want to reduce our lifestyle based on the market? We want it to be steady. We want our income to be steady. Again, index annuities can help with that. As opposed to, in this situation, if you're willing to you can increase to 4.5% as long as you stop spending when the market's down. The next, equity-heavy allocations tend to support higher lifetime withdrawal rates as well, but you've got that same that same need to then reduce spending when the market's down, because a equity-heavy allocation is also going to mean higher volatility and risk. And when you see, if you had an S&P 500 index fund right now, you'd be down 18%. Whereas with the stock bond portfolio, you might be down about 12 to 14%. So big, this can add up over time. All right, I get some more I want to cover with you, and then we're going to talk about helping you find the right annuity for you. Okay, in your given situation. And again, they're not for everybody, but for most people, I find there's a lot of benefit there. So we'll get into that and more. First, a break. Join us here. I'll be right back on the Retirement Report.